Ladies and gentlemen, today we welcome Sandeep Singh, President and CEO of Osisko Gold Royalties. For those of you who had the pleasure of attending my Natural Resources Investment Symposium in Boca Raton, Florida, you would have had the opportunity to listen to Mr. Singh and meet him personally. For the thousands of you who weren't able to come down to Florida, this is going to be the second best thing. First of all, Sandeep, thank you for your support of the symposium, and thank you too for subjecting yourself to this Q&A session.
Happy to do it, Rick. It was great to get together in person again after so long and see you and the crowd. It was a great show. We got a lot out of it, and certainly happy to talk to you anytime.
For the newer listeners to our series, Sandeep, perhaps we could start off with you giving an overview of what you see as the investment attributes of the royalty and streaming companies, particularly vis-a-vis other mining industry investments.
Sure, happy to start broadly. We've had this conversation. I do think we are entering the phase which suits gold royalties, precious metal royalty companies the best. In a world where inflation is no longer transitory, it's real, it's deep-rooted, and the Fed is doing everything they possibly can to push us into a recession. This is when, as sad as that is for the rest of the economy and maybe all of us on a personal basis, that's the best possible backdrop for us as a gold royalty company. We offer that safe haven gold investment that is much needed and frankly underweight in most people's portfolios. I do think that will change. We do it in a diversified way. For us at Osisko, we have 20 different producing assets this year in a basket of 165. We're diversified by asset, we're diversified by geography, and we don't have the OPEX and CAPEX risk that many miners are suffering through right now. If you're following the quarterly reporting, it's been a tough season. And I think in the mining world, especially, that mining inflation, which is labor intensive, energy intensive, capital intensive, is going to continue even longer than in the broader economies. So at the end of the day, it's gold exposure, it's inflation protected, and it's growing, at least for us it is. So this is the best possible backdrop for us.
I think it's important for our listeners to note very, very specifically that yours is a financial interest. If you have a 5% overriding royalty interest, you get 5% of the revenues. But when they're passing out either a CAPEX bill or an OPEX bill, you don't get one. On an operating basis, effectively, net of refining at least, your gross is your net.
Yeah.
Can you give the audience some sense of your operating margins?
Yeah, and that refining is a trivial amount. We're talking, a few dollars an ounce, really. So that's exactly right. So, for instance, you use 5%. I imagine you were thinking of the Malartic royalty that we have. So Malartic, for those that don't know it, is Canada's largest gold mine. It's the mine that our team, our predecessor company, and our founders built. For instance, found, delineated, financed, built, and then sold. It's currently run by Agnico Eagle and Yamana. And we get 5% of the ounces off the top line, no matter what the cost structure of that mine is. Thankfully, and we want our partners to be healthy and making a lot of money as well. That is one of the most profitable assets for Agnico and Yamana as well. But regardless, we get 5% of the ounces off the top. And to your point, whilst they might have creep in their costs because they're going through inflation, our costs remain essentially zero on those ounces. So we get about 35,000 free ounces just from that asset alone per annum. That production is going to carry on for decades. And in the spring of 2021, they made the investment decision to build the underground portion of that mine. The underground right now has in aggregate 15 million ounces, and it's growing. That's to the tune of $1.3 billion for them. And again, our contribution to that is zero. So the beauty of the royalty model, if you do it right, and if you choose your assets correctly, which I would say we have, is, you pay some fair value for what that asset is at that point in time. And then anything that comes thereafter, you benefit from disproportionately because you don't have the finding costs and you don't have the extraction costs. So it's a pretty great model when you do it well. That said, I think it's also a benefit to the sector. There's a lot of people looking for capital in a capital-intensive industry, and our capital is important to the sector. There's not enough, oftentimes, equity and debt to fund the projects that need to be funded. So I think it's a win-win that works for both miner and royalty companies.
One of the things that I've noted that many, even of the mining analysts, haven't noted around the royalty space is that your indirect costs can be lower too. If I walk through Agnico Eagle's headquarters or Yamana's headquarters, you have, by necessity, dozens, maybe hundreds of technical people, geologists, engineers, financial people that are involved in the operation of 12 or 13 mines around the world. Yours is a financial interest. You need to spend a lot less time and hence a lot less money on engineering, on geology, on cost control. So it isn't just that your site costs, your direct costs are lower. Your indirect costs have the ability to be much lower. Could you talk about that as a bit? You've been a financial officer really in every aspect of the mining business. So if you could talk about those differences.
Look, very true. So not only structurally do our royalties come at low cost, but our G&A is also quite low. And you're right, it's hundreds of people, not tens of people at some of those mining operations. And then obviously, as you get to their sites, you're talking about several hundreds of people, if not thousands in some cases. So at Osisko Gold Royalties, we have about, it rounds to about 25, maybe we're up to 26 people globally in really an office space. Half of those people would be kind of the people you need to run a dual listed TSX NYSE listed company. The other half would be more capital markets facing, be it IR or corp dev or what have you. So a very thin team. And frankly, that's all the people we will ever need, give or take. So that business is very scalable. What we're doing is we're searching for new investments. We're looking to deploy capital. That's all I've done in my background. You kind of hinted to it. I'm not a technical person, although I've been in mining for the better part of the last 20 years. So know enough to be dangerous, but I'm a financial person that surrounded himself with one of the best technical diligence teams in the business, I think. So really what we're doing is we're deal making and we're diligencing assets. Once we have our exposure, we keep an eye on those assets, but they're being run by other people, which is why we don't have the same workforce. But again, all the people we need to do our jobs and all the people we need to continue to grow this business to whatever size we want to grow it to, we don't need to add more people as you would when you pick up new assets on the operating side.
Let's look now at the genesis of the company. It seems to me that there were 4 transactions at least. The one that spun off the Malartic royalty, then the acquisition of the Virginia asset, then the package transaction that you did with Orion et al. So if you could take us through the corporate history and talk about how the company was created with a description, if you could, of all of the major assets in the company.
I'll do my best. I don't know how much time you have on your hands, Rick, but you hit the high points. I guess I would say. So yes, back to what I was referring to earlier. Osisko One, if you will, was the entity within which Malartic was built and operated and ultimately sold in 2014. If you recall, there was a hostile bid from Goldcorp at the time. And all of us, myself as an advisor of the company at the time, worked to create more value and ultimately ended up selling the company for about $4.3 billion to Agnico and Yamana, spinning out the royalty company in the process. So that was a win. And in doing so, we made sure we had as much exposure to Malartic as possible. And that decision, I think, has proven out to be wildly successful given what's happened to that asset just in the last couple of years. From there, we had one producing asset within a basket of 4 other exploration assets, basically. So phenomenal flagship, but not necessarily diversification. And the team, again, with Sean Ruzin as the lead and myself as an advisor amongst the larger team, set out to grow and to grow creatively and to build some diversification, actually turn it into a royalty company. quite successfully. Virginia was the first major transaction bringing in the Eleanor royalty. It hasn't exactly played out as advertised at the time. It was relatively early stage, but it's still a core asset for the long term. It's currently run by Newmont. It's a great partner. The Orion portfolio in 2017 brought with it a lot of assets and a lot of diversification. That was just north of $1 billion transaction, so it was a large transaction for the group, and brought in assets like Mantos and Casino and others. So that brought a fair bit of the diversification. When you fast forward and you look through all those transactions and you get to where we are today, I think I hinted at it earlier, from one producing asset to 20, from 5 total assets to 165. So built a real company, centered that company in good jurisdictions. So most of our value is still in the Americas. When you take Canada as 75% of our value, you add the US and the right parts of South America, you get into the low 90s. So we've built that diversification. We're associated with some of the best mines and some of the best miners in the business. I'll talk to you about some of those as well. And we've done it in good jurisdictions. So I think we've built a very important portfolio in the royalty business. One that matters, one that is senior scale, just happens to be in an intermediate company body. So that's the quick synopsis of 8 years of hard work.
Let's talk a little bit about financial stability. Describe, if you can, other than with adjectives, the balance sheet and the income statement. Do you have adequate capital to grow? Do you have foreseeable adequate capital to grow? What sort of recourse and non-recourse liabilities might shareholders inherit?
Yeah, look, it's a good question. And we have a phenomenally strong balance sheet is the upshot of it. Rough numbers, we have 300 million, just north of that actually, in cash at the end of the second quarter. We have, the only debt we have is 300 million in converts that come due at the end of the year that we intend to pay out. We're making cash flow every day as a royalty company at a 93% margin. We build up cash every week. And we have a completely undrawn credit facility with 650 million that we can use to grow our company. And that's what we will use to fund growth if we can find growth that we find accretive and value enhancing to the portfolio. So all the capital we need to grow the business. The only assets that have contingent payments are really only a couple, and they're small. So most of the assets that we have that are going to fund our growth are all bought and paid for. We bought and paid for them in a $1,200 to $1,300 gold environment. We intend to benefit from them in a gold environment that's much more supportive, and we think going further. So we certainly picked the right time of the cycle to deploy capital. And the balance sheet today is still extremely strong. We raised $250 million in March to fund some acquisitions that are in the works, have been announced but are in the works. So that's what strengthened our balance sheet. We raised that money at $13.45 US. Today, even though we're coming off a record quarter and looking forward to a record second half, stock prices drifted down towards $10 US just because of market malaise and a lack of interest in the gold sector. But the business is exceptionally strong and the balance sheet is exceptionally strong as well.
So summarizing that, basically current assets and current liabilities balance. You have $650 million in dry powder in a credit facility. And what's the sort of midpoint of guidance in terms of cash generation this year?
Yeah, so we're guiding to 90 to 95,000 ounces delivered to us at a 93% margin. Pick your gold price, but in and around where we're talking right now, you're talking about a cash margin of about $150 million. From that, we run our business, we pay our moderate G&A. And then everything else after the taxes is available for either padding the balance sheet or for funding new growth. So yeah, we're in exceptional shape. I didn't even mention it, but as it happens, we also have on a bad day, we have about $450 to $500 million worth of equity investments in other sister companies. Not all, obviously that's less liquid, but that's sitting on the balance sheet as well as a pretty nice asterisk.
Well, that's interesting. between $400 and $500 million in equity investments. What would you suggest then, net of that, your enterprise value is? Market capitalization, less debt, add back cash, and
Sure.
redundant.
Yeah, so our market cap today in US dollar terms is probably about 2 billion. Back off that number, we're probably sitting at an EV of US 1.6 billion, give or take. As you said, the rest of the balance sheet cancels itself out. If you're looking at some of our assets, if you're looking at some of the recent transactions that have happened in the sector, Cortez being the most recent, if you apply those multiples to Canadian Malartic, which is our flagship, but it was only 35,000 ounces out of our 80,000 ounces last year, that asset alone could justify our enterprise value if you compare it to what the deal flow is out there. So we got a lot of inherent value in the company, and we're looking to continue to unlock that value in a more supportive market.
Or put differently, you're generating, you're trading, in effect, your enterprise value is 10 times EBIT in a 93% operating margin business.
Exactly.
That's by any stretch of the imagination, but particularly at these interest rates, that would seem to be an extremely attractive value, given that the majority of the EBIT comes from long-lived assets that have exploration development upside. Let's move on to competitive and comparative advantages relative to other players in the space. You're not the biggest guy in the space, but you are also by no means the smallest guy in the space. How do you compare, both with the dozens of juniors nipping at your heels, and also with the behemoths that crowd you at the top? What are the competitive and comparative advantages to grow in this space?
Look, I actually happen to think, and you're right, there are some much bigger players with significant multiple advantages, so cost of capital advantages. But I actually quite like our sweet spot as to where we are in the middle, if you will. We're not really looking to compete with some of those smaller players. There's been a lot of new entrants in the smaller scale, building up generally earlier stage portfolios. Some of them have done a good job of that. But when we look for, we have so much early stage in our company already, assets that people lump together with $100 million research NAV. Individually, we could spawn a dozen of these micro royalty companies by seeding them with assets. So we're not looking to compete on the early stage. Frankly, when we do early stage investments, they come to us through our network. They come to us through our technical team. If you're a geologist and you're pushing forward an asset of merit in the Americas, odds are you want our team to know it, and you want our team to endorse it. You're probably bringing it to us first, or certainly that's not always the case, but it happens enough for us to make good use of it. On the larger side, in terms of groups that can pay significant cash outlays to fund real projects, big projects, the group is really the same. It's been the same competition for some time, and we've always managed to fare well within it. The reason I say I think we're in a sweet spot is our business is it's growing if we do nothing. We're growing. We did 80,000 ounces last year. We're saying 90 to 95 this year off of existing assets getting bigger. We've got exposure to some of the best development assets we think in the business, and they're going to start to come on in the next several years. So we have the ability to grow by a double-digit compound rate, if we invest next to nothing. That's pretty special. And then to that, we think we're still a size of company where we can do, enough deals to grow, and only will grow if we can do it accretively. Anytime we put money to work, we compare it against, is that a better use of capital versus just buying back our stock? And when our stock is trading as it is right now below NAV, it's pretty hard to make that determination. It's pretty hard to say we're not better off going and getting more exposure in Malartic and our other assets. So I think we're in a good place. We don't need to do billions of dollars of deals a year like our larger peers do. They're in some ways victims of their own success. And the world to finance is relatively finite. There's not a laundry list of mining operations that we like out there. It's a finite list. It ebbs and flows, but within it, we see enough to do to grow our business. If we don't, we won't, and we'll grow organically. But I think we do still see enough to do it to grow our business. And again, if you're looking at some of the prices that are being paid to fuel those bigger businesses, it's getting tougher and tougher. But our business is one that can continue to grow.
I want you to go a little deeper into something you just said. To me, the most outstanding part of your presentation was in Boca Raton, was the fact that you looked at every transaction as to whether or not it was accretive on a per share basis. As a guy who doesn't own your whole business, but rather owns some shares, that was refreshing to me. So if you could talk about the sort of per share hurdle rate, how you look at investments and how you compare them with buying back equity, and also how you look at the difference between dividend distribution as a form of returning capital to shareholders versus buying back shares. I think that would be a discussion that would be appreciated by a more sophisticated audience.
Yeah, I'm happy to do that. And there's quite a bit there to discuss, I guess. It makes no sense to do anything unless it is accretive. And you can measure accretion in different ways, NAV per share, cash flow per share, et cetera, but it has to be accretive for us to care. We're trying to stick to high asset quality and things that improve our business, not take away. So that's a given. And I think the proof is in the pudding. I mean, I think it's not just lip service. You've heard me, Rick, for the better part of 2.5 years, my tenure, and certainly the first year and a half of that, saying we just found growth too expensive in the sector. In 2020, equity markets were wide open, debt was available to everybody, and the deals we saw in that market we thought were higher risk assets getting pretty low return funding, and we said we're going to opt out of that. We're going to be disciplined, and we'll pick our spots. And if that means we're going to have to do smaller transactions, kind of hit some singles and doubles for a while and wait for our moment, then we'll do that. And that's exactly what we did. We hit some singles and doubles, brought some really nice assets into the company for cheap, and then we waited to pick our spots. And then we, lo and behold, our spot was in Q1 of this year when the equity markets were essentially closed to everybody else, and we used that window to deploy some more capital. So that's exactly how we're going to continue to run our business. If the deal flow makes sense, if it's accretive, it measured in a number of different ways, per share metrics first and foremost, asset quality, then we'll transact. But we have no pressure. I feel no pressure to grow for the sake of it. As I said, to be able to grow this size of company, you can grow a company by 10% per annum, if you're a micro cap. But to be able to say that over the next 5 years, we expect double-digit compound growth is exceptional. And to that, if we can add it, if we can add smartly, we will. If we're a window of time where we can't, we won't. And if you think about the royalty sector, it is a contrarian sector. You should at least be contrarian, in my view. And when the markets don't need our capital, we shouldn't be rushing to put it to work, because we're not going to get good deals. And when the market is like it is right now, and it desperately needs our capital, then we're going to be really active. And that's the way we're running our business, and that's the way we'll continue to run our business. In terms of dividends versus buybacks, middle of last year, we upped our dividend by 10%. It's already a peer leading dividend, I believe. It's the highest in our sector. So we pay a real yield right now of about 1.7%. We upped that last year, as I mentioned, by 10%. And then we went out in the next month or month and a half, we bought back 1.5% of our company. So if you take the dividend with the buyback that we did, we've returned, if you will, 3% of the business to shareholders. And we're happy to keep doing that. If the market is as volatile as it is right now, our underlying fundamentals have never been stronger. Q2, we never generated as much, GEOs. We never had higher deliveries of gold and silver, essentially. We never had higher cash margins. And yet our share price is amongst the lowest it's ever been, just because of that pendulum swinging with the gold price weakness and the US dollar strength. So that's what the market's going to give us, an opportunity to buy back Osisko at these current levels. We're happy to take more of our cash flow and do that. And I think we can do all of the above. I think we can continue to pay a peer leading dividend. I think we can continue to take advantage of weakness in the market. and I think we can continue to grow the business, smartly.
Some of your competitors and would-be competitors are beginning to participate throughout the capital stack, making equity investments, as an example, to get access to royalties, streaming as opposed to merely participating in royalties, and two, in the case of, as an example, Orion, competing in project lending or building a debt book. Do you have any aspirations or any willingness to participate in the rest of the capital stack in terms of growing Osisko?
It is interesting. You're right. There has been a kind of step change in what our peers are doing to get access to the royalty and streaming side. Things that they've never done before, never been willing to do before. It's interesting, Osisko, because we started from scratch, we had to build out a company. We were a little bit more nimble in the past, and those are some of the things we've actually been criticized for doing. Now we're, lo and behold, our larger peers are having to do the same. I think for us, we're interested in, if we can get an early stage royalty, sprinkling in a little bit of equity to make that go down easier, make that a bit more digestible for the other counterparty, sharing risk that way. That's always something that we've done before others. And I think we'll continue to do that in moderation. But we worked hard, Rick, to get ourselves back in the middle of our lane, where we're a pure play royalty and streaming company. Certainly there's room for, as I said, that's the meat on our plate. If it helps to put a little bit of equity here and there, for instance, on the CSA transaction earlier in the year, we threw in a little bit of equity, but the chunk of our dollars are going towards royalties and streams, and we can still see enough of it in our pipeline to continue to grow that way. I think what you're seeing, without nitpicking on other people's deal flow, but I think when you're seeing those types of transactions, I think when you're seeing people diverge from what they've been steadfast about in the past, those should be, canaries in the coal mine a little bit. Those are kinks that are starting to show up in the armor, and I think it's all in keeping with that theme of, when you're that big, it's really tough to grow. It's tough to maintain the growth trajectory that they've been on. Those $500 million streams in 2016 and 2017, when the base metal sector, the diversified sector, was just in terrible shape balance sheet wise, and you had the likes of Glencore and Teck and Vale and others selling streams on world-class copper assets. That's not the world we're in right now, and probably won't be for a really, really long time. So it's tough to grow those businesses. They're having to deviate a little bit. Again, they're great companies. They trade at a multiple advantage, so they got a lot of things going for them. But that's one headwind they have. That's not a headwind that we particularly see at Osisko Royalties.
Finally, Sandeep, and we're going to wind this up and give you a chance to get back to making us some money. But finally, one of the things that you said in Boca Raton that really impressed me was when I asked how investors could learn more about the company and who they should contact. You gave the best possible answer. Perhaps you could repeat that now. If people want to learn more about Osisko Gold Royalty and they have some detailed questions, who should they contact and how should they contact that person?
Well, they should contact us. So at the bottom of every press release, there's an email address to our IR team. That goes to an actual person. It doesn't go into the abyss. So we're reviewing those, and if you're not hearing back from our IR team, you're hearing back directly from me. We were quite happy to hand out business cards in person again, Rick, and that business card has my cell phone on it. So if people want to talk to us about our business, we're very proud of it, and we're very, very happy to talk to them, especially your crowd. It is a sophisticated group of people that understand the gold sector, and those are the types of people we want keeping up on Osisko. So go to the website, look at the bottom of a press release. If you write to us, I guarantee you will hear back.
Sandeep, flattery will get you everywhere. Thanks for subjecting yourself both to Boca Raton and to this interview. And thank you too, as a shareholder, for the incredible job that you've done. I look forward, I hope, at seeing you in future investment symposiums and also having the opportunity from time to time to subject you to scrutiny like this.
Yeah, whenever you're free, Rick, we'll chat. It's always a good time. It's always useful for me as well. And thanks to your audience for listening, and happy investing.
Well, thank you too, and goodbye. I'll leave you go now.
Okay, take care.